Hi guys, so let's now take a look at fixed exchange rate regimes. Right, so when it comes to a fixed exchange rate, this is where a currency is pegged against the value of another currency. Now, it's likely that you will actually peg between a band where you have a price floor and a price ceiling, rather than a very, very specific price, which can be really difficult to maintain otherwise. So let's just take a look at this little diagram, just illustrating a currency band on a pegged exchange rate or a fixed exchange rate. So here we're considering that the pound is fixed against the euro. If this was the case, then a lower price floor for the pound against the euro would be £1 equaling 1.1 euros, and a price ceiling would be 1.3 euros per pound. Okay, now the monetary policy authorities, i.e. the Bank of England, would then have the responsibility of maintaining this fixed exchange rate. Okay, so they would buy back up British pounds when necessary to support the demand, but they would also supply more to the market to actually increase the supply if the price level of the pound was increasing above or potentially above that ceiling threshold. Okay, so that's the way in which a fixed exchange rate operates. Now, they tend to be used by LEDCs primarily, and there's good reason for this, as we'll see in these advantages highlighted in blue here. Okay, so first up, it really does promote a lot of stability. It promotes stability because it means that businesses and consumers will know what the exchange rate will be in 6 months, 12 months time. For investment decisions, if a multinational corporation is looking at investing in a foreign country, again, it means that they know what the actual likely cost scenario is going to be in 6, 12 months times. And therefore that stability can really help to promote inward foreign direct investment into the economy, as well as supporting domestic investment in LEDCs. It also limits, of course, currency volatility, because you will just experience some fluctuations between that given band rate, and that limits the potential for importing inflation as your currency depreciates. So remember, weak pound imports dear, exports cheap. So if your currency depreciates, it means the price of all foreign goods will suddenly rise, and that can generate significant cost push pressures. Well, pegged or fixed exchange rates help to avoid such scenarios. Okay, next up, we've got the fact that it can also help to develop the credibility of policymakers. Now, it helps to develop the credibility of the monetary committee, the monetary policy committee in a given country, as well as the political authorities, because they are actually saying this is where we will fix our exchange rate. It will fluctuate between this given band, and that can reinforce the markets and build and promote market confidence within the actual authorities that are within that given economy. Okay, further to this, it also ensures policy discipline. Now, this is significant, and it does link back to the second point that I've highlighted here, because if you wanted to finance your budget deficit through printing loads of currency, well, what would happen? Well, your exchange rate there would be a surplus in terms of the actual supply level actually generated in the economy, and as the supply of the currency really increases, the exchange rate band would be broken. So it does tie the hands of policymakers and ensures discipline. Likewise, if interest rates were increase significantly, well, you'd increase beyond the level of your band. So you've got to make sure that at all times you are operating within the restrictions that this currency band does offer. Okay, and overall we've seen as well, it can help to actually keep inflation low, and that is a significant advantage for LEDCs, particularly when you think about the actual absolute poverty that may be present within various LEDCs. And inflation is potentially a real killer to people that can barely get their hands on food as it already is. Okay, so that can be a really significant advantage. Okay, the downsides, however, and there are numerous downsides to this. Firstly, that it can conflict with macroeconomic objectives. So in maintaining the currency rate, you may actually need to increase interest rates just to support the demand for your currency, and of course that can restrict economic growth. Then you've got a scenario of SPI, strong pound, imports cheap, exports dear, and so your export sector may become less competitive if your currency is overvalued. That may then result in a current account deficit, of course, and require financing from abroad. Okay, so furthermore, it may require high interest rates. Right now in Argentina, interest rates are as high as 40%, 40% in order to maintain demand for their currency, okay? It's really questionable how long that situation can actually be sustained, but Argentina is undergoing a speculative attack right now. Okay, and one of the reasons Argentina is being subjected to a speculative attack is because they run a significant current account deficit, but moreover, the policymakers also run a fiscal deficit. So the politicians and the government in Brazil actually run a fiscal deficit as well. So these deficits require financing. They require financing from abroad, and that requires dollars or euros to be converted into Argentinian peso. And well, how much Argentinian peso do you want to hold when there is a real risk of the currency actually collapsing out of the exchange rate band? And this is why these fixed exchange rate regimes can really be subjected to speculative attacks. Okay, and that's our final down point. And this happened so nastily with the Asian financial crisis, then subsequently the Russian financial crisis. All right, but it's not like speculators, currency speculators, will just target fixed exchange rates. They will target countries with certain vulnerabilities, such as big current account deficits, okay, highlighting the fact that the currency may be set at too high a level in the export sector, not competitive enough, that they may have a big fiscal budget deficit, as Russia did in 1998, and so on. Okay, guys, great stuff. I'll see you on the next one. Thanks very much.